$5 billion. Not in a hedge fund. Not in a family office. Not in a Swiss bank account with a fake name. In a Roth IRA. The same account your HR rep told you to open after your first paycheck. The same account the IRS lets you contribute a maximum of $7,500 per year, 2026 limit, into. So let me ask you something. How does a man start with $1,700 in a retirement account and end up with $5 billion in the same vehicle? The answer is not a glitch. It is not a loophole in the criminal scene. The IRS knows about it. Congress has held hearings about it. Multiple GAO reports have been written about it, and yet it happened legally. Today we're going to break down exactly how Peter Thiel turned $1,700 into $5 billion inside a tax-free retirement account. And more importantly, what the architecture of that move looks like for you right now in 2026. This is not financial advice. This is financial intelligence, and there is a difference. It's 1999. The dot-com bubble is at maximum pressure. Money is flowing into everything with a .com attached to its name. Most of the money will evaporate. Most of those investors will be humiliated. Peter Thiel is not most investors. He co-founds a small payment startup. At the time it's called Confinity. You probably know its later name, PayPal. Here's where the play happens, and I need you to watch this closely. Thiel uses a Roth IRA, but not the kind your bank offers. He uses a self-directed IRA. We'll get deep into the mechanics in the next segment. For now, just understand it holds real assets, private company stock, startup equity. Inside that IRA, he purchases 1.7 million shares of his own startup, PayPal founder stock, at a price of $0.001 per share, 1/10 of 1 cent per share. Do the math with me. And this math is simple on purpose because the concept underneath it is everything. 1.7 million shares of a company for $1,700 sitting inside a tax-free retirement account. Was that price legitimate? The IRS requires that assets inside an IRA be purchased at genuine fair market value. And here is the key. In 1999, PayPal had no revenue, no proven product, no guarantee it would survive. For a pre-revenue startup at that stage, was a defensible and documented valuation. This is not fiction. This is how early-stage equity works. Fast forward 3 years. eBay acquires PayPal for $1.5 billion. In 2002, those 1.7 million shares are now worth substantially more than $1,700. All of it, every dollar of that gain, sitting inside a Roth IRA, where capital gains are not taxed, where dividends are not taxed, where withdrawals in retirement are not taxed. The IRS built that wall, and Thiel simply walked through the door the IRS left open. And then he kept going. He reinvested inside the account. Early Facebook single $500,000 angel round in 2004. Palantir. Other venture bets across 2 decades. Each one compounding tax-free on top of the last. By 2021, investigative journalists at ProPublica obtained leak IRS data covered through tax year 2019 and published the number for the world to see. $5 billion in a Roth IRA. One man, one account, 0 taxes owned on gains. Senators call it obscene. Legal scholars call it a masterclass. The IRS called it legal. To understand how this is even structurally possible, you need to understand the difference between the IRA your bank gives you and the IRA Thiel used. When you open a Roth IRA in Fidelity or Schwab, you're using what's called a custodian-controlled IRA. The custodian, the brokerage, decides what you can invest in. Stocks, ETFs, mutual funds, maybe some bonds, and that is the entire menu. But here's what most people never realize. The limitation is not in the tax code. It's not an IRS rule. It's a platform restriction, a business decision made by the brokerage. The IRS itself permits something much broader. Enter the Self-Directed IRA. An SDIRA uses an independent custodian, a company that specializes in holding alternative assets. And the IRS explicitly allows these accounts to invest in a dramatically expanded universe. We're talking private company stock, startups, pre-IPO companies, real estate, rental properties, raw land, commercial buildings, private equity and venture capital funds, precious metals in IRS-approved forms, tax liens, cryptocurrency through certain custodians. None of this is secret. The IRS publishes the rules in Publication 590B. Most people have simply never been handed that document. Now, let's talk about the most powerful upgrade with the SDIRA structure. It's called Checkbook Control. The way it works, you form an LLC that is wholly owned by the Roth IRA. The custodian funds the LLC. You as the manager of that LLC has literal checkbook level control over the capital inside it. That means when a private deal surfaces, a startup seed round, a real estate opportunity, a private equity placement, you can write a check the same day. No custodian approval lag. No bureaucratic delay. In private markets, speed is capital. Checkbook Control gives SDIRA investors a weapon that standard IRA holders simply don't have access to. Now, there are rules, hard lines the IRS draws, called prohibited transactions, and they exist to prevent exactly what you might be thinking. Rule 1. No disqualified persons. Your SDIRA cannot transact with you personally, your spouse, your parents, your children, or any entity you control in a way that creates a direct personal benefit outside the IRA structure. Rule 2. No personal benefit. You cannot live in a property owned by your IRA. You cannot draw a salary from a company your IRA controls in a conflicted way. Rule 3. Arm's length valuation. Every asset must be purchased at genuine fair market value. Artificially depressing a price to move assets into an IRA below value is not a strategy, it is fraud. Thiel's 1999 transaction was engineered to respect all three. The valuation was contemporaneously documented. The company was genuinely pre-revenued. The purchase was structured at arm's length. The line between genius and crime here is documentation and intent. Know the line. Okay, I hear you. Great story, but I'm not co-founding PayPal. Fair. Let's talk about what this architecture looks like in your world right now. There are 3 strategies available to non-billionaires that apply the same core principles. Thiel used move assets with extraordinary growth potential into a tax-free structure before that growth happens. Before, that word is everything. Strategy 1, SDIRA plus early stage investing via crowdfunding platforms. Thanks to the Jobs Act of 2012 and its expansions, retail investors, not just accredited, can now access early-stage startup deals through platforms like AngelList, Republic, WeFunder, and Start Engine. The play? Open a self-directed Roth IRA with checkbook control. Fund it. Then use those funds to invest in early-stage deals through these platforms, or directly into private rounds if you have the network. Even if one of these bets produces a 10x, a 50x, a 100x return, and these are the return ranges that early stage ventures actually produce. The gain is completely shielded inside your Roth SDIRA, zero capital gains tax. You do not need to find the next PayPal. You need to find a diversified portfolio or high upside bets inside the right tax structure. That is the play. Strategy 2, the Mega Backdoor Roth. And this one is available right now to millions of W-2 employees whose HR departments have probably never mentioned it. Here's how it works. 3 steps. Step 1, max your standard 401k contribution. In 2026, that's $24,500. $32,500 if you're 50 or older. Step 2, check if your plan allows after-tax contributions beyond that limit. Many 401k plans, particularly at larger employers, allow additional after-tax dollars up to the total IRS cap of $72,000, inclusive of your employer match. Step 3. Convert those after-tax dollars into Roth status inside the plan if it allows in plan conversions, or roll them over into a Roth IRA. This is the mega part. Let me do the math so this lands. Standard Roth IRA limit, $7,000 a year. Mega Backdoor Roth potential, up to $47,500 additional. Combined, $53,000 plus into Roth annually. Run that at a conservative 8% average annual return over 20 years. You're not talking about a comfortable retirement. You're talking about a fundamentally different level of wealth. All of it tax-free on the back end. One critical caveat. Not all 401k plans allow this. You need your plan to permit both after-tax contributions and in-service conversions or distributions. Pull your summary plan description or ask HR directly today. Strategy 3. QSBS, Qualified Small Business Stock. Section 1202 of the Internal Revenue Code. And this one is criminally underused by startup employees and early stage investors. Under Section 1202, if you invest in or receive equity from a qualified small business, you may be eligible to exclude up to $10 million in capital gains from federal taxation when you sell. Up to $10 million in capital gains, excluded from federal tax. The qualification requirements: the company must be domestic, C corporation, gross assets under $50 million at the time of stock issuance. You must hold the stock for at least 5 years. The company must operate in an eligible industry. Most tech and manufacturing qualify. Real estate and finance generally do not. And you must be the original issuee. You cannot purchase QSBS on a secondary market. Let me make this concrete. You join a seed stage startup in 2020. You receive equity currently worth $50,000. The company exists in 2026 for $200 million. Your stake is now worth $4 million. Under Section 1202, assuming all qualifications are met, you could potentially exclude the entire $3.95 million again from federal capital gains tax. $3,950,000 of gain, potentially zero federal capital gains tax. And here is the advanced play. QSBS and a Roth SDIRA are not mutually exclusive. Some investors hold QSBS outside the IRA to capture the Section 1202 exclusion directly, while using their SDIRA for other high-growth private bets. The strategy can stack. When they stack correctly, the tax outcome is extraordinary. Here's where I give you the complete picture, because if I don't, someone in the comments will, and they'll be right. The Government Accountability Office has published multiple reports specifically on what they now call mega IRAs, accounts that have grown to sizes the tax code never anticipated when these vehicles were designed. In 2021, the Build Back Better Act included provisions that would have prohibited IRAs from investing in companies where the account holder owns more than 10%. Required mandatory distributions from accounts exceeding $10 million, and restricted SDIRAs from certain alternative asset classes. Those provisions did not pass, but they will be proposed again. Bipartisan frustration with mega IRAs is real and growing. Legislative risk is a real variable in your planning. The implementation is strategic, not paranoid. The window for certain SDIRA structures may not stay open at its current width indefinitely. Build your structures now. Build them correctly, and for the love of your financial future, use qualified tax professionals and SDIRA specialists, not YouTube scripts as your legal foundation. This video is a map. The territory requires professionals. Let's bring it back to where we started. A $7,000 a year retirement account, $5 billion. The gap between those two numbers is not luck. It is raw genius. It is not even access to information that was hidden. It is structure. Peter Thiel understood something that most people never taught. Tax-free compounding applied to the right assets at the right moment in time over a long enough horizon produces outcomes that are functionally indistinguishable from magic. The specific assets Thiel used are not available to you. Founder shares at 1/10 of a cent per share. Those moments are not on a platform for retail investors, but the architecture he used is available to anyone willing to understand it. Self-directed IRAs are open to any American with earned income. The mega backdoor Roth is available to millions of W-2 employees whose companies offer it, and most of those employers have never heard of it. QSBS protections exist right now in the current tax code, waiting to be claimed by founders and early employees who simply don't know the mechanism exists. The wealth gap is not only an income gap, it is an information gap. The people who know these strategies are using them right now. The people who don't are funding the retirements of those who do. This channel exists to close that gap. If this moved the needle for you, share it. Not for the algorithm, because financial education is one of the most valuable things you can give someone you actually care about. Subscribe if you want more. We're building the blueprint one video at a time, one decision at a time. Until then, Dynasty doesn't happen by accident.